There are two things here. One is the attractiveness of the UK as a venue for foreign investment. And the second is how we mobilize the resources that we have in the UK better. On that first point, when I go abroad and I travel maybe 100 days of the year, going to 25 to 30 countries, I talk to the largest asset owners and encourage them to have more of their assets deployed in the UK to be managed by our brilliant UK asset management industry. And we have about £11.6 trillion of money managed in London. It's the second largest centre for asset management in the world. About 45% of that is owned by overseas asset owners. So that continues to grow, and we have a target of building that up to £20 trillion by 2030. So that, I think, is a course of action that is well set, well established. The City of London Corporation, together with the Investment Association and the Department of Business and Trade, are very well focused on that plan. But the second point, which I think is really important, is that we have the second largest pension system in the world, £4 trillion approximately. About half of that is in DB pensions and about half in DC and SIP pensions. There is a lot that we need to do better about how that money is invested. And I think there really is a role for making sure that we stimulate the best parts of the growth economy by giving some exposure to pensioners, to those growth companies, tech, fintech, life science companies that we're so good at producing in the UK. We've got more fintech unicorns than the rest of Europe put together. We've got more fintech startups. The US and the UK are the two leading countries for fintech startups.
We don't have the jewel in the crown, though, and that is Arm. Big hopes that the company would at least consider a dual listing here in the UK. Now, as you embark upon this trip to San Francisco and to Chicago, can I ask you what you will say to investors if you're quizzed about why technology names are simply not valued as well as they are valued in the United States? We've seen it in the past with Deliveroo. We've seen it in terms of other big name technology companies where simply the rewards are not there for investors, and for those entrepreneurs wanting to take companies public, they just get better returns in the States.
Well, I think if you look at what's happened in the last couple of years to technology stocks in the US, there's been a lot of volatility in valuations. I would say that there is a stronger risk appetite from US investors for early stage companies. And don't forget that the startups that we produce here in the UK have consistently attracted the most sophisticated investors in the world. It's not just because they're deemed to be cheap, but they're deemed to be outstanding businesses with great managers. We need to keep those businesses in the UK. Excuse me. So that's why I'm very keen to make sure that we reverse this process of what we refer to in the markets as de-equitization that has undermined the success of UK stock market for the last 15 years. So creating a big future growth fund, which is what I'm proposing, a £50 billion growth fund to be funded over a period of time from DC pensions, can put equity, private equity, into these companies. It can make a very strong statement about our UK intent to keep these businesses starting, scaling, staying here in the UK. That, I think, will make a big difference. And once we do that, we'll start to see a rebalancing of valuations between the North American market and the UK.